Hi, Bruce Miller here. Welcome to our broadcast. You know, if you like this broadcast, we would sure appreciate it if you would share it with your friends. We're trying to get as much exposure to this video as possible. And if you don't like it, please keep it to yourself. November, what a month of drama. My gosh, we had a presidential election thrown in there. And then as soon as the election was over, the fiscal cliff. And not only the fiscal cliff, but what else? More political bickering. Almost the day after the election. But for all of the drama that occurred, the markets themselves were relatively unchanged. Let me go over a few of them for you. Gold was up barely 1% for the month. Oil was up 3%, but that's not much considering the volatility we've seen in oil. And the investment markets, the NASDAQ, the S&P 500, the Dow, they were all within 1 percentage point of being unchanged. Pretty amazing when you think about the media and the conceptions that people have about how bad the market is. It wasn't really that bad. And you know what? The reports that I saw were not bad either. In fact, they've been coming in pretty strong for the last couple of months. We saw good reports on housing, reasonable reports on employment, considering the fact that Hurricane Sandy was thrown in there. We saw good reports on durable goods, on leading economic indicators, on manufacturing categories. Pretty much across the board, things look good, including internationally, which is often more important than our domestic reports. Things look very strong in China right now, for instance. So what happened with the markets? Why are they so unchanged for all that good news? It's almost as if we're complacent. Complacency is a scary thing, but it's not just about being complacent. It's the yin and the yang, the push and the pull. As soon as the election was over, in spite of the positive reports, we had stories surface about the fiscal cliff, the dreaded fiscal cliff. Now, I want to refer you to a video that we did prior in the middle of September on the fiscal cliff. So go back and take a look if you want to learn more about the fiscal cliff. But we did that quite a long time before it became the flavor of the day for the media. So take a look. But generally, I think things look pretty good, except for the fiscal cliff. Let's talk about that. You know, most people, when you hear an analogy on TV, they talk about a truck heading for a cliff, going over the cliff with rather stiff consequences. But I'd like to, if I could, change the analogy a little bit. And I'd like to take you back to a former life that I had. You see, I used to be an Air Force fighter pilot. And sometimes we would enter a difficult circumstance called a stalled condition. And in an aircraft in a stalled condition, you oftentimes will add power. Through power, you add fuel to the engine of the aircraft to try to get out of the stall. Well, I would liken that our economy is like that fighter jet. It went into a stalled condition at the end of 2008 and the beginning of 2009 during that terrible fiscal situation that nearly tore down the whole economy. And it has pretty much maintained that stalled condition from then until now. And what we've seen the pilots of this economy, I would name him Ben Bernanke, do, is to add more power. In the fighter jet, we had something called afterburner. Oh my gosh, we saw power added to the max, and then we saw the afterburner kicked in, and we're going full throttle trying to get out of that stall. But as most pilots will tell you, it's not just power that's going to get you out of that stall. So let's liken that aircraft as if it's heading for that cliff. And I'll tell you what, when I'm in a stalled, precarious situation like that, and I see a cliff coming, it's pretty good news for me because it's going to give me more options as the pilot. And so I would liken that cliff in part to be political realities, misconceptions that might occur. And as that cliff happens, and some of it will happen, it may be an opportunity for us to push the nose forward a little bit, which any pilot will tell you is the key to breaking a stall. And along with the power that's applied, it would get us out of that stall faster and get that economy heading up in a pretty significant fashion pretty quickly. Now, just because the economy starts to recover and gets out of that stall, which I think we'll see, we may already be seeing it, it doesn't mean the markets are going to react as favorably. Now, you know, the markets are up over 100% since that near calamity some years ago. Economy didn't follow it up. At the same time, as the economy starts to recover out of its doldrums and that is broken, we may not see the markets follow the economy upward at the same time. See, some of the byproducts of the fuel that are being added to that economic engine are stimulus packages and low interest rates and a lot of free money that hedge fund managers and institutions are using to leverage themselves to the hilt and to buy more and more investments, hence the increase in the stock market over the past few years. As we break the stall, as that power is reduced, as the fuel, the stimulus, if you will, is reduced, as the interest rates are raised to break it, we may see some problems in the market. So just because the economy may break out of its stall, the markets may continue to be troubled. But I do have to tell you, I'm very encouraged right now. I like what I see. The positives far outweigh the negatives. But I also want to say that the implications of the negatives, if they go past a certain point, are so great that it makes me want to be so cautious as to possibly miss the next rally to avoid the next downturn. So I would say, proceed with caution in these perilous times. Err on the side of the conservative. I still think there's money to be made in these markets. So Ben, let's go do some cliff diving.